ratio. Actually, let me try something. I'm gonna. Oh, cool. All right, folks, thanks for joining me. And we did have a few technical difficulties, but I hope that we have that taken care of at this point in time. So what we're doing here on the roadmap to trading options is really, the roadmap is indicative of our process through trading, okay? Usually what happens is we come up with a directional assumption, and then we start looking at this underlying. That's when we find the right option strategy. And right now what we're going to be doing is the ratio call spread, aka the front ratio call spread. And it's key to note that it is the front ratio call spread. Why? Because I don't teach anybody how to do the back ratio call spread. Why? Because I don't really believe in the way that strategy is structured as it would be beneficial to any one of us trading, to be quite honest. So later courses, I will teach the back ratio call spread, but that would only be as an example as to why we wouldn't want to use that. In this one, I do like the front ratio call spread. So that's why I obviously teach it. And there is a great time and a place for this specific strategy, and we'll talk about that down the road. But for right now, let me get a couple of things out of the way real quick. My name's Eric Wilkinson. Some of you guys very well may recognize me from mainstream media, where I've talked about economic data, geopolitical environments, and how that comes into impact markets with some of my market analysis. I started trading in college with some money I had earned, decided to get a finance degree, moved to Chicago after graduating, jumped into the pits at the Chicago Board of Trade, and I've been trading everything from stocks, financial futures, commodity futures, currencies, and options on all of these products in just about all market conditions. In that 27 years of trading, I've learned how to streamline your process in order to find the right strategy for your trading, okay? Why? Because I know when I was on the floor, we didn't have the opportunity to pick buy or sell and stuff like that. We had to make markets, and then the customers would trade with us. So that caused me to become very mechanical and hypersensitive as to what was going on and what would be beneficial for this strategy or would hurt it. And I've done a lot of research on this, and I think that I've, even for the savviest traders, have found some niches that you guys can take home, some wisdom nuggets that you guys can even take home, I should say. All right, so this is, like I said, on the ratio call spread, but we never go into any trading day. We don't wake up and say, I need to put on a ratio call spread today. At least I hope you don't. I hope that you're looking at, your charts or whatever, and however you come up with your directional assumption, that's the first step in the process. So what happens, the way I teach, is we come up with that assumption, and then we look at that underlying, and we find the right option strategy for whatever assumption we have. So we do have to go over this roadmap key, and we're going to be talking about the Greeks here. And yes, I want you guys to stick around a little bit longer. I'm going to try and help you guys find ways to really think about the Greeks that will make you understand them intuitively, so that you'll look at them and be like, okay, delta is data. It gives us all kinds of information, probabilities, and all of those things that I'm not going to talk about right now. What I want us to focus on is how delta affects those options premium in relation to that underlying. And when we're talking about it, we're talking about this first dollar move higher. All of the Greeks are assuming we're moving higher, moving out in time. We're never moving backwards, okay? So the assumption is that we are gaining or moving forward in time. So some of this stuff we kind of went over before our snafu. So let me just erase all of the ink on this slide, and we'll start over on this. So what we're talking about with delta is that first dollar move higher, right? So we would be talking about, for instance, BABA, the last trade would then move up to 229.89. So exactly $1 move, right? This is an increase of $1, all right? Exactly. So we're we're kind of trying to isolate everything else so we can try to compare apples to apples here and go from there. So if we moved up by $1, we would expect that our premiums in relation to the corresponding delta, you know, obviously this delta is going to affect this premium, okay, because it's corresponding to it. But let's just talk to these at the monies right now. And we have a 52 delta. So if the underlying BABA moved up by exactly $1, all else being equal, then our premiums we would see would increase from $14 even to $14.52 and then $14.72, all right? So exactly a 52-cent increase in those premiums from the bid and the offer. You know, the mid-market's going to be right there in between that. And then when we go back to the Greek channel, let me see if I can get this so I can. It's not going to. All right. Whoops. So let's talk about gamma. Gamma just goes with delta. All right. Gamma goes with delta. And we talked about this being dollar number one. Now, gamma is dollar number two. So when we go back to our option montage, we already saw that on that very first dollar move higher, we saw that our premiums increased by the delta. Well, now we're talking about, now we would be at 230.89, right? So that's a total of $2. Okay, so we're talking about our second dollar increase. Now, our premiums are still there, but now we've got another increase of gamma. This doesn't have the gamma on there. Let's look at failing, right? Let me pull up an option montage here. All right, so we've got all of the stuff we need right here. So we'll have to play around with these, and I'm going to use this particular platform here. All right, so let's go with these prices. We talked about delta because it's going to be the same. We went from 226.90 to now 227.90, right? So that's that first dollar move. So let's talk about delta again. That's this column. We would increase by 50 cents. We would talk about $13.60 then. And on the offer, we would be at $13.75. So still increasing that 50-cent delta to the corresponding option strike here. So in this particular case, we're talking about the 230 strike. You know, obviously, if we were talking about one of these out further out, we would be talking about, say, the 290s. These would increase by that corresponding delta, all right? So only 8 cents on that first dollar. But let's stick with the ones that are at the money. Now we're talking about that second dollar move higher. So now we're trading at right 228.90. So that's the second dollar move higher. So now we've got a dollar number two move, all right? So gamma then would go with delta on that second dollar move. And our premiums would now be looking at $14.11 on the bid, and then on the offer we would be looking at $14.26 on the offer, right? So that's how our premiums would just increase with the underlying moving higher. Now, if we're talking about negative moves, we would obviously need to, because the assumption is moving forward. And we see over here on the calls that it's positive. On the puts, it's negative. Because if the underlying was to move higher, these puts would lose value, all right? On that move higher, 45 cents out of these corresponding puts would come out, all right? And then the same thing goes if we were looking at delta, or the second dollar move, a negative delta plus a positive gamma would then, the next dollar move, only lose 44 cents, okay, right? A negative 45 plus a positive 1 makes that 44, all right? And vice versa, if we were moving down, a negative move plus a positive delta would make that delta negative, and then a negative move plus a negative delta, a negative plus a positive makes that a positive delta. So if we start moving down, the puts start getting bigger, And if we start moving down, the calls would then start getting less valuable, right? Thank you for using the white writing on the comments because it's much easier and more visible to read than the red. Thank you. I appreciate that. I will keep that in mind moving there forward. All right. So does that make sense to everybody? Delta is positive because it's the assumption of moving higher on the calls, and the puts are negative because the assumption is still moving higher. And if we have a negative move, we have to add that negative component to the delta and on the calls and the puts, right? A negative move plus a positive delta makes that a negative delta to our premiums, and a negative plus a negative makes that a positive. And the same rules go with the gamma. A negative move plus a negative delta makes that positive delta plus the gamma on the second move, you know, would make that increase that premium there. And then, then we also have the, oh, I got to get rid of this, sorry. Then we have theta. Theta is our thief. Theta is the thief in the night that comes and steals our premium. And I'm trying to figure out if I know how to change this ink color real quick. I'll try and change it to white there for you from now on. All right, so theta is the thief in the night that comes and steals our premium. That means that every single night, you know, theta comes in and erodes those premiums that we have in our option montage. So in this case, I'm going to try and erase all of, actually, I don't even want that anymore. I want to, sorry you guys, I'm shooting from the hip right now. So the option montage, let's pull that back up again and look at theta. Now theta is the thief in the night, right? And that's the column right here. You'll notice that both on the calls and the puts, theta is negative. And why? Because every day that goes by, that thief in the night comes and steals those premiums. We can't go back in time, all right? We can only go forward. And so therefore, with options, theta is always a negative, all right, to those premiums, all right? So tomorrow, we would wake up and assume that we would see 17 cents come out of these premiums if we opened up exactly at the same place. All right, nothing else changed. Just tomorrow we wake up, we would see 17 cents come out of our strikes on this specific strike. You know, you can see that theta is different all the way out the curve. The further away from at the money we go, theta is a little aggressive, less aggressive, and further out in time. If I add another option, we will be able to pull up here. We will see that theta is less aggressive way out in time than it is on these nearer duration. We can see 7 cents here, and we're going to see, you know, 17 cents here. So less aggressive, further out in time, more aggressive the closer and closer we get to expiration. We could get inside of, you know, 8 days. We can see that this theta component is really ramping up, all right? So if you're selling options premium, what would you want to do? You want theta on your side, right? So you kind of want to get into the wheelhouse if you're selling premiums inside of theta's, you know, zone, the thief zone. So we would want to get nearer duration. My sweet spot for selling options is around 35 days to expiration, or as close to 35 days to expiration as we can get. In this case, we can see that 8 days to expiration is a little too tight. 43 days is really where we're going to be concentrating because that's the spot month again. But again, if you know you were selling premiums, this is the option montage you're going to be looking at. If you're buying premium or doing something for a debit, you'd want to go further out in time and limit that theta component. All right. So theta is the thief in the night. Every single night comes in and steals some premiums little by little. More aggressive the further out, or sorry, more aggressive the closer to expiration, less aggressive further out in time, more aggressive at the monies. All of those things are going to come into our decision-making process, so we really need to understand those relatively good. going up $1 move, but the strikes are $5 wide. Do you see the dollar move? Yes, it's for every dollar move. So a $1 move, those would move up. Even though they're $5 strikes, the corresponding delta is still going to affect those premiums for every $1 move, okay? So if it was a $5 move, then you would multiply 5 times the 50 cents that, you know, and you know, we have to think about gamma being in there also because it's taking place on the second dollar move. It's a penny here and a penny there. So it's going to increase, you know, that gamma over $5, right, will increase my delta by a total of 5. Does that make sense? Because the first dollar move, I got 50 cents. Second dollar move, it would be 51 cents, right? Because gamma goes with delta on the second dollar move. Third dollar move, gamma goes with delta again. So now we're talking 52 cents on that third dollar move, right? 53 cents on the fourth dollar move, right? So it's going to continue to increase like that. All right. So Vega. Vega is one of the most important Greeks, and it's actually not even really a Greek letter, to be quite honest. Delta, gamma, and theta are in the Greek alphabet. Vega is not, and it's the most important, to be quite honest. Vega is just volatility, all right? And I'm always just going to abbreviate it vol. I'm not going to write it out and waste your guys' time. Vega, if you hear me saying vol, I don't care about the volatility or the volume very much. I care more about the volatility, all right? So Vega is the volatility, and that is one of the most important things that is going to affect our options premiums at any given time. Volatility is more aggressive further out in time, all right? So if you want to take advantage of volatility expanding, you definitely want to think about going out there in time, right? And when we talk about theta, we want to limit that thief in the night. We go further out in time. Well, expansion and volatility affects those further duration ones. So the idea here is if you want to take advantage of cheap premiums, volatility expansion, limit theta decay, you're going to go out in time and you're thinking about your buying premium. Whereas if you want to take advantage of volatility coming out, being those premiums are already super inflated, and you get that volatility crush. And if you guys were watching the daily market commentaries recently, you saw me just do this with SPY in a matter of one day. I got that volatility crush. So that's what we want to take advantage of, some of that theta decay, volatility crush. This is where we're going to be looking at around 35 days to expiration. So taking advantage of volatility contraction and high premiums you're selling, and you want to get a little bit closer to expiration. So Vega is always positive. So we can see here on the option montage, Vega is positive in both calls and in the puts. All right, kind of draw around there so I don't cover up those. Vega is always positive because when volatility expands, all premiums go up. All right. So if it goes up by 1 percentage point, being we go from 54.57 to 55.57, so 1 percentage point increase, all right, then our premiums would go up by the corresponding Vega, all right? So if all else was equal, we were just sitting here, the underlying didn't move, but we just see Vega uptick by 1 percentage point, our premiums would increase, and we would see that go from 1310 to 1341 and 1356, right? So that 1 percentage point, even on the puts, we would see those premiums increase by that 31 cents, and we would see then 1361 and 1406, right? Something like that. Okay, so that's increasing. Now, volatility moves quite rapidly. I mean, we're talking, you know, that's when we're seeing like five plus tick moves in volatility at any given time, whether it's to the upside or the downside. So we're trying to discern what this number means in relation to all of this option montage. That's paramount to understand. So if you don't go away with anything else, you forget about delta being data, gamma goes with delta on that second dollar move. Theta is the thief in the night, which is still important. But Vega, understanding Vega and how that determines or what that's doing to the premiums is paramount in determining any option strategy, okay? All right, so we've got the Greeks. We understand those. Now we're ready to get going. So we're looking at where are we going. So what I mean by this is you're trying to decide what kind of trade you can put on, right? Where are we going to be bullish? I usually just flip through the watch list and look for opportunities there. I don't even really look at the underlying when I'm looking for opportunities. I'm kind of looking at chart setups, and I'm guessing you do too, or maybe you have a service to give you bullish and bearish moves and stuff like that. That's fine as well. What we're talking about here is we're looking to come up with a directional move. So let's just say I was flipping through the charts and I came up with this BABA example. Now, I don't like putting strategies on around earnings, okay? We do have an earnings happening here. So if you guys could really just bear with me and let's pretend, we don't have an earnings going on, okay? Can we do that? Can we all agree to have that be one of our things that we're talking about? I don't want to implement this strategy around earnings because I have specific rules around earnings trades. But in order to fit my the ratio call spread, I need to assume that we have high volatility, right? Those are one of the things that we're talking about. So where are we going? Ultimately, what I want to talk about is I think that BABA is going to kind of stay right here, okay? I believe that BABA is not going to really move anywhere. It's going to kind of stay right inside of this kind of area, all right, and just trade back and forth. But I'm a little worried about this downside risk. With all of the things that, all the headwinds with BABA right now, is just really how I'm coming up with it. It's not necessarily wholeheartedly what I believe, but when we're going through these charts and we're coming up with an assumption, this is the assumption I'm going to use here. But this, I do not think is going to happen. What are you basing that on? The BABA will not move. Well, Trevor, that's my point. I really don't think BABA is going to move, but I do think the risk to BABA is to the downside, especially if the government really starts clamping down on them. Ma has been spouting off and been hiding for a while. All of those things are pretty much headwinds to BABA. Yes, I just don't believe that the upside is really in, and I'm willing to take that. And I think that because whenever you get around this point of control, markets have a tendency to settle down. And if they do settle down right around this area, I could easily see the volatility coming out of this, all right? So ultimately, I don't think that this is part of the scenario. I am worried about this part of the scenario of the market breaking down and selling off. So I want to eliminate my risk to the downside. And if it stays right here, I am just a happy as pig in a blanket, right? Because I'm right at the point of control and the market will start settling down. Was he arrested? I heard he was in a bit of a hiding situation. So if it goes up, we'll talk. We're going to pull the ripcord on it if it starts breaking some of our support and resistances is what we'll talk about. So my assumption is it's market neutral, all right? I am worried about the downside in this underlying. For the upside, I'm not too worried about it, okay? And that's just my assumption. Everybody else's assumption might be different. You guys might be like, you're crazy that this stock is going to go through the moon. And that very well be the case. That's what makes a market is everybody's assumptions are just that, right? They're assumptions. So, and I want to use this as an example of what we do when we come up with an assumption. is how we go through it. And my assumption, my personal assumption in this case for this webinar is that it's going to be market neutral and bearish. So that's one of the things that we've just come up with. And I'm not saying this as a trade recommendation based on my market analysis, folks. It's really based on being the perfect, one of the best candidates for creating this strategy around, okay? But we're trying to lead to that, all right? Putting the cart before the horse in a sense. All right, so the next thing we have to do is, do we have a good destination? Is BABA a good destination is what I'm saying. And when you're thinking about a destination on a roadmap, it's like, are you going to go to the middle of nowhere and try to find something to do, you know? You're going to go to, you know, the middle of Iowa, and that's not Iowa, that's Kansas, right? Or is that Nebraska? Anyway, ultimately, I think we wouldn't want to end up there. We want to end up somewhere where there's something going on. There's a lot of eyeballs. There's a lot of things to do. There's free market price discovery going on in full swing. And that's ultimately what we need to discern from the option montage. Now, you can click over here and go to the high-low volume to see that there is good volume and open interest on something like BABA. That is definitely a possibility. But what I usually have is the option montage setting up where we have the regular option montage with all of the Greeks. I don't usually switch back and forth from the main page like this where we have the option Greeks, but I tried to take a screenshot of this before the close so that because the markets will get wider after the close. All right, so just to make sure when we're on this page, if it is a stock that is over $100, so the stock is trading over $100. So if it is greater than $100 on the underlying, all right, if it's greater than $100 on the underlying, we need to move the decimal 3 ticks to the left and go 1, 2, 3. So we have a $228 stock, right? Go 1, 2, 3. So right there, we're looking at 22.8 cents. All right. So ultimately, what we want to do is then look at the option montage closest to 35 days to expiration, because that's the one that is has all of the volume and open. It's the spot month is really what I want to say. You know, we can round this up to 23 cents also. You can see that it fits, the bid offer is pretty close to fitting in line with all of that across the board. So if it fits my rule, what I like to say with this in building this out is that if it fits my rule, then it is a green light, to kind of go with that analogy of oh, there it is, sorry. To fit my analogy of the whole roadmap. Okay, give me a stoplight. All right, so if we have our stoplight, if it fits the rule, we're going to be looking at, if it fits the rule, it's a green light. You know, it's fitting the rule most of the time here, but if it's basically, you know, less than, if it's the rule to 2 times the rule, we're talking about a yellow light. All right, if it's between 2 times and 3 times the rule, then we're talking about a red light. So in this case, just to break it down, you know, the green light would be, in this case, less than 23 cents from the bid to the offer here that we were talking about. And this would be, for the yellow rule, we'd be looking at less than 46 cents. And then the red light would be, you know, like 69 cents or something like that. You know, anything 69 cents, just walk away. The bid offer is just way too wide, too much wiggle room to deal with it. If it fits my rule for the green light, folks, that is telling you there's full free market price discovery going on. All right. When there's really wide bid offers, it means that there is not very many people making markets in there. they get a little bit wider. So that's my rule for stocks over $100. If we are looking at stocks that are less than $100, so if my stock is less than $100, meaning, you know, a smaller denomination here, the rule is basically then it needs to be less than or equal to 10 cents wide, and that becomes our green light there. That would be the green light because that fits the rule. A yellow light would be 2 times the rule still, all right? You know, so we're talking like 20 cents here. That would be that yellow light. And then the red light would be, if it's less than $100 and it's 3 times that rule, 30 cents wide to the bid offer on a stock that's less than $100, I would not trade options around it, all right? So just kind of walk away from that, right? So easiest thing over $100, move the decimal 3 ticks to the left. That's how wide the option montage should be. If it's less than $100 stock, then it needs to be less than or equal to 10 cents, all right? That's how we determine if it's a good destination. That's how we know we can trade options around it. Now, the next thing we do, so we've come up with our directional assumption, right? It's neutral to bearish, or I've come up with my directional assumption. I don't want to play that off on you. It's not a trade recommendation. But I've come up with my directional assumption that's neutral to bearish in BABA. I've gone to the option montage. I figured out, okay, you know what? There is a lot of free market price discovery going on there. The bid offer, the options trading are very tight markets, so I can get involved. I don't want to get involved in something that's really wide because, you know, then you're part of trying to make that price discovery happen, and most likely you're going to have to give up a big edge to get in, and therefore you're probably going to have to give a big edge to get out. So we want to stay away from that. Now, I need to look at what's going on around BABA to decide what that environment is. And when I'm talking about the environment, I'm talking about volatility. And think about volatility as when it's sunny, it's, you know, there's no risk. You can see forever. There's no danger really in sight, right? So there's low volatility. But when there's high volatility, it's kind of like it's rainy out. You know, you're white knuckling it. You can only see like, you know, 20 feet in front of you. So you have to discern what's going on in this underlying. Is it experiencing high volatility or low volatility? And what we do by that is we look down here at implied volatility for BABA. I'm not talking about the VIX, folks. I'm talking about implied volatility specifically for this underlying, okay? And I put the chart down here so we can follow along with it. The reason why is because I don't care what the VIX is. It doesn't tell me if BABA has high volatility for itself or not. So, you know, I like to discount the whole pandemic start where we didn't really have anything. I also like to discount the fact that we probably aren't going to see volatility as low as we saw back in 2019, basically. I think that we are going to continue to see higher volatility like we saw, you know, through the summer of 2020 and, you know, for the probably until at least the summer going forward. So therefore, I think that this is a good representation of what BABA's volatility will feel, because every underlying has its own volatility coefficient, and it also has a tendency to have an area where it finds highs and lows, okay? And those are the extremes. So when this current underlying is experiencing a 54, let's call it 54.68, right? We can see that this volatility chart is relatively high. It's at the higher end of this range. So we could easily say that that is experiencing high volatility, right? If it's down here, if this chart had traded back down here, this would be low, right? It's at its lows. But right now, we are currently at this near high. So we could say, just by looking at a chart like that, we could say that we have, that BABA has high volatility, right? And I mentioned this. Why does volatility matter? Because as volatility expands, those premiums go up. Well, in this case, we have those premiums already at an elevated level, right? So therefore, we could expect volatility to go down now, all right? Because we've seen that happen several times before. When we get up at these elevated levels, right, we see that volatility come out, you know, and even in and around these earnings. It doesn't always have to be in earnings, but when that gets up there, it has a tendency to want to come back down. And that's what we want to take advantage of. We know we have high volatility. So that's the time to take advantage of extremely expensive premiums, right? Because if those premiums go down and you've sold them, then you sell high and buy low, right? Even if the underlying doesn't move or the time doesn't pass, we've already talked about these types of moves. And when I was talking about that volatility crush, we can see how much it comes out from 54 all the way down to like 40. So there's your 14 percentage point moves. Remember, we multiply, it's every one lot, so you could multiply whatever that volatility component was, the Vega, times 14, and that's how you can discern if we got that kind of volatility crush. That's what would happen to those premiums right away. All right. So that is why volatility matters, is because when we're looking at them, we need to know if volatility is high, we're going to be looking to sell premium, and if volatility is low, we're going to look to buy premium. You know, you buy cheap, you sell expensive. It's that simple. But the hardest part of it is discerning whether or not it is high or low. And we talked about this. When it's high, it's up at the upper band. Yes, we can see what happened during that pandemic, but I don't think that that's going to happen. We also see that we are elevated compared to what we were seeing in 2019. And, you know, I want to take that out of the equation, at least at this point in time. All right. So when we're looking at this, let's dig down into it. So for those of you that, you know, like to streamline that process, I'm all for it. You know, you can kind of draw your bands. Okay, we can see where there is resistance and support in this, right? You know, you might even have your line where you're discounting this one down blip, but I want to keep it in there. So if you want to streamline your process, I have no problem looking at this. If you really like to look at the details, what we need to do is we have a mathematical equation to come up with this. I have the script that will go in your watch list. I'll show you other places where you can find this number as well. It's called implied volatility percent. Now, what that is it's basically telling us where the current volatility is in relation to the extremes, okay? And it doesn't mean that if we assume that the extreme was here before, that it, you know, it could still go outside of those extremes to the high and low. But I'm saying that this is pretty much black swan event, or this is the black swan event, and I don't think that we're going to see low volatility for some time, so I'm going to go with that. But if you like to really dig into the details, what you need to do is you take the current implied volatility, IV, I'm just going to call it, minus the low IV, all right? And you take that sum and you divide it by the high IV minus the low IV, all right? So again, we're just trying to find out where the current IV is in relation to the high and the low is ultimately what happens here. So if I was to look at this specifically, take out all of the noise from before, I would say let's just call this somewhere around 58, okay? So the high is 58, I'm going to call it. The low is somewhere around, let's just say 30 to make math easy. Let's just say this number is 30 and this is 58 on the high, okay? So we take the current, which is 50. I'm going to round it again because I'm doing math late in the day. Current minus the low, which is 30, right? We take that sum and divide it by the high, which is 58, minus the low, which is 30. So basically, we're coming up with, what is this, 14 and a half, or 14 and a half, 24 and a half, 24 and a half, divided by, which equals 24.5 divided by 28, all right, which is going to equal right around 87.5, all right? So 87.5 percentile. My rule here is anytime if implied volatility percent is greater than a 50, all right, that's when we are looking to sell premium. All right, and if it is less than 50, we are looking to buy premium. All right, now if you are very new to options trading, this is for you know, a pretty decent risk parameter. If you are newer to options trading and you believe that you have a lower risk parameter, I have no problem with you guys switching this out and saying like above 70, you're going to sell, and less than 30, you're going to buy. All right. But my encouragement is, you know, after 6, you know, months to a year or something like that, reevaluate your risk parameters, try and increase that risk tolerance a little bit. That's always a good thing. You know, and that goes for saying, you know, when you've had a good year, to slightly increase your normal tranche size. I'm not saying you double it, you jump out where you want to make trades and you're worried about them anymore. I'm just saying you slowly increase your tranche size, all right, which is increasing your risk parameters. So we can see that this one is 87%. BABA is in the 87 percentile. If we were to pull up the option montage over here and take a look at this, we can see that BABA is saying it's at 60 percentile. It's still above 50. It fits my rules there. But we can also find it down here. I have the script to be able to put it up over here. But here's another place you can find it. Current implied volatility percentile, 61%. It's rounding that up, obviously. And the reason why that number is different is because it's taking into account this high of 72.5 and this low of 27.5, okay? So if we were to do the math with that, we would come up with right around a 60 IV percent. All right, but because I wanted to discount that, I need to really narrow down on that. So again, well, I get the right. We know we have high implied volatility. So again, review real quick. We looked at BABA. We have, or I have a neutral to bearish assumption in it. I have looked at to make sure it's a good underlying to trade. That's that tight bid ask. It has that. I looked at the environment. I'm realizing it has high volatility. If it has high volatility, I know that those premiums are expensive. And remember, when premiums are expensive, we need to look at something where we're collecting a credit for it, or we're selling ultimately premiums. And if we're selling premiums, who do we want to be on our side? Yes, that's right. The thief in the night that comes and steals our premiums is who we want to be on our side. So we want, when we're selling option premiums, because those option premiums are very expensive, we want to sell high, buy low. We need to think about having Theta be on our side and help us out with that. So remember when I was saying the sweet spot was this 35 days to expiration here? Well, that's because you can see that those at the monies, or, you know, all options are a little bit different there, but we can see what happens to options premiums inside of this 36 days to expiration. Much steeper here than out here, right? And the further out you go, this is going to kind of flatten out even further, because that thief in the night is more aggressive inside of 35 days to expiration. And this is what happens to those premiums. So when you're collecting a credit, you kind of want to be inside that 35 days to expiration, or as close to it. We're talking about that 45 days, right? As close to 35 days to expiration. Sometimes you have to go a little bit further out, but you can see that we are still getting that massive Theta component. We're getting in right before Theta gets super aggressive, all right? So we've got all of these things. Mostly my directional assumption being neutral to bearish, I need to take advantage of. I'm not worried about the upside, but I am worried about this downside move. So I want to protect against any downside move because I have no worry about the upside move. I'm kind of leaning towards that market neutral to bearish type of strategy. I have high implied volatility. That means I need to collect a credit for it. So in my case, I'm going to be thinking, what vehicle are we going to use? The ratio call spread, all right? So what spots do we visit? Well, we're going to be doing I don't really like to do the in the money necessarily. I like to concentrate on these at the monies. Gives me a little more wiggle room to the upside. If you thought that when you implemented this strategy, the underlying you had is like the perfect spot right there at the money is where you think it's going to end at the end of the day, then you're going to be using it slightly in the money. But for me, I would rather give myself a little bit more wiggle room to the upside. And by doing that, the at the money fits that bill quite nicely. So ultimately, when we build this strategy out, I'm going to have to pull up the other page because I didn't get the rest of this in there for some reason. It's not on the thing there. Oh, yeah, I got it. Can you guys see this bottom? It looks like to me it might be cut off. So ultimately, like I said, there's no risk to the downside here. There's zero risk to the downside. Zero risk to the downside. You can see because right here we have a little bit of wiggle room right here. Right here would be our max profit. All right, so if the underlying is trading right there at my short strike at expiration, that's how I can collect the most amount of money. All right, and I've got quite a bit of room to the upside to get to my break even, and I'm going to go through how we find all of these out. The main thing I want to talk about here is this is really taking a long call spread and adding a little bit of risk to it to create, and this says back ratio spread. It's not a back ratio spread. It's a front ratio spread, think or swim. For some reason, it auto defaults. It doesn't matter. If you build it out as a back ratio spread, it'll say back ratio spread too. So it's not like it's messing that up too. It's just for some reason, a front ratio spread shows up that way. But rest assured, this is a front ratio spread, despite the fact of what they're saying. And this is ultimately what it's going to end up doing. Now, we have to do this for a credit or a scratch, folks. And that's because if we're adding risk to it, we need to be rewarded for it. So like I said, when we're building this strategy out, I'll pull up the BABA again, and we'll look at it from this example, despite the fact that these are going to be a little bit wider than normal after hours. So I'm going to buy the at the monies. That's really close to it. One could argue, well, why don't you do the 225s? We could do that and look at it as well. So I'm buying one of those. Now I'm going to go about, I need to look at this $15 debit I'm going to pay. Let's call it $15.50. And I need to look at these options, the ones I'm going to sell, and make sure that I can get $15. So I'm going to go, I'll go $20 up and see if it works out. No, you can see that debit doesn't work out. If I'm adding risk to this strategy, I need to be rewarded for it. This would create risk to both sides. I want to avoid risk to the downside. All right, so let's change those. Now I've got a credit. All right, so ultimately, you need to look at the one that you're buying and then move higher to the options that are going to pay off that debit. All right, so we bought the at the monies. I need to look at whatever credit I'm getting and find the option that will pay off that debit to create that credit then, right? Because that credit is what allows me to eliminate all risk to the downside. Now, yes, I am adding risk to the upside. The reward, you add risk, you get reward. I'm adding risk. My reward is I'm eliminating downside risk. If this was done as a long call, right, I would be having risk to the downside. I wouldn't have any risk to the upside, right? But I would have risk to the downside. So I want to eliminate that. I could do a iron butterfly, or I could do something like that where I'm worried about, I think that it's a market neutral strategy, but because I'm worried about the downside, that iron condor and stuff like that doesn't fit my objective, right? Because I still have risk to the downside with the iron condor. I want to eliminate all risk to the downside, right? Any questions so far? Does that make sense? All right, so you guys got this. We talked about this, the direction. That's the first thing you come up with. In this case, I came up with a market neutral to bearish assumption. I want to eliminate the bearish move and be able to profit from that if that happens. So we've got that. The destination, this is the eyeballs, right? Is that underlying option tradable? And that's my rule of moving the decimal, 3 ticks to the left, and making sure the option montage is according to that. You move it 3 ticks to the left, we were talking about 23 cents. The environment, I have high implied volatility. And the reason why it's good for high implied volatility environment, think about this. We talked about the expansion in those premiums, and the at the monies are going to be, really all of these options are going to be very expensive. Therefore, this spread is actually able to get a little bit wider. If we were to look at this BABA trade when volatility was, 10, 15 percentage points lower, we would notice that instead of more of a flattened out curve like that, it would be more of a upside kind of move, right? It would kind of look like where it was just a little bit more narrow is what I'm trying to get at there. We'd probably still be trying to do it for a credit, so it'd look like that. But this one would definitely have a higher peak going on than this one would have a flatter peak going on. Okay, that's maybe a better drawing of it. The duration, because we have this high volatility, we have high vol. I want to go, I'm thinking I got to collect a credit. If I'm collecting a credit, I want to be looking at 35 days to expiration, or as close to it. It's ish, you guys. We're trying to get as close to 35 days to expiration, getting involved in this strategy, because that's where that volatility really comes out. And we talked about this. I like to do the at the monies. Some people like to do the in the monies, but I like to do the at the monies and do it for a credit. For a credit. All right. We don't want to add risk to one side and not be paid for that handsomely. And the way to do that is to do it for a credit. We're adding risk to the upside, eliminating all risk to the downside. All right. Max profit is basically the width of our spread, the long call, between the long call and the short call. I wrote this up, the short call, the long call, so you don't come up with a negative number. But basically, it's the width of those two strikes plus the premium, because we're getting a credit, right? So our max profit, if the underlying were to stay right at our short strikes, we talked about this, this is our max profit. And if we put all this together on this example, we would see our max profit is $16.97, right? Because it's $15 wide plus $1.97. That's $16.97. That's what this number would show across here is $16.97, all right, on that one. Okay, so that's spread plus the credit, because we call it a credit there. Now, we can see to the upside that our max loss is infinite. This underlying can continue to go higher and higher. All right, so you need to have, your thought as to your exit strategy when you're pulling the ripcord on this one. All right, you could look at it as if it breaks above like 260 basically, right around there, because that's going to be right around your break even. At the end of the day, that's where you're getting out of this. And that's a pretty substantial move in probabilities to be able to have that happen. So that would definitely be a thing that you would be thinking about on your exit for a loss. Now, if it goes down this way, I'm not going to worry about it at all, because I get to collect that credit. I have no risk to the downside. That credit would be staying in my pocket. Trevor, I see your question. I'll get to it in a second. Your break even is, that short strike, that extra short call strike. In our case, we were looking at the 245 calls. That short strike plus the width of the spread plus the premium received. So we talked about the width of the spread was at $15, and that's how we came up with this break even. In this case, we saw the short call, the 245s, that lines up right here. That's the short call plus the width of the spread. We've got 15, 16, 17. So right here, our break even is going to be looking at around 261.97, right? 261.97 is our break even. Right? The short strike 45 plus the width of the spread is 15. We're looking at 260 plus the credit, 261.97. All right. Now, if we go back and look at the charts, if you like to do it as a chart setup or something like that, I was looking at this as well, where I would look to cover this type of trade on a chart, and the reason why I picked those strikes is, we're going to see resistance up and around that area. It's a little bit higher than where I'm looking at right now, but we can see that there is an area where we would start seeing resistance here, and it would start coming in right around after covering that gap right there. All right, so that's what I'm kind of looking at happening is, this gap type of thing. And it might go up there, cover that gap, but I think that that's where the market would have its major resistance. And that just so happens to be right around that, the 262 area, okay? And I am worried about this downside move here in the underlying. I am worried about this rolling over and just really free falling. But, the check mark for me is that it's going to trade in a relatively tight range around that area. That's where I came up with my strategy. Trevor's asking, how do I come up with how wide? Well, one of the things that we do know when we're looking at the option montage is we know that these premiums are expensive, right? So we want to collect a credit. What I do is if I wanted to do, let's just do another example of the slightly out of the money. These are really considered at the money. So I want to buy this. I'm looking at, $13, okay? So I look at $13 debit that I would be paying. I need to figure out if I sell two of something, that pays for it. So I know intuitively I need to at least get $6.50, right? Because half of $13 is right around $6.50, right? I need to pay off of it. I'm selling two of them, so about half of it. Does that make sense? I need to pay off that $13. So this is not going to get me $6.50. This one easily does that. That's how I'm picking that to get the credit, okay? I know that $7 will twice will add up to 14. That gives me a credit. That's how I pick that move. But we know that the width 60 is where my break even is. You can see that's a 21 delta. It's really almost out to a 1 full standard deviation move with this. That's high probability of success, all right? Now, if I were to say I wanted to get out of this, I would say if it maybe broke above, let's say this area here, I would throw it out. And I have no problem. Like maybe you're looking at, the Fibonacci's and you're drawing it up like this. You know, that's kind of following in line. I'm doing it real dirty on this. But you could say, okay, it breaks above the 38 Fibonacci here. That's where I'm out. I have no problem with that type of setup, all right? You know, you can see right here that Fibonacci 244. That lines up right with my short strikes. So if it came up and bounced up, found resistance right there at that strike, that 50 Fibonacci, that would be perfect, right? If it breaks above there, I'm going to be on high alert. If it starts breaching this 38, that's where I'm pulling the ripcord, all right? And write all of those things down, however you come up with it, all right? I see a couple questions. I'm going to try and do it. So we are looking for a slow-moving stock. Yeah, or you just, the expectation that this stock maybe has had a big move. That's created that volatility, and now things are going to start settling down, okay? You have to be approved for your brokerage on level 4 strategies, those unlimited risk like naked option strategies, sellings. Do you do something with the ratio spreads? Great question, Mark. Love it. Thank you. And this was something I wanted to bring up earlier on, where this was going to be somewhat similar to the broken wing butterfly. So if you guys watch that broken wing butterfly, the broken wing butterfly webinar, it's kind of similar to this, whereas, you know, broken wing, we went double the distance. So this is 15 wide, right? A regular butterfly, you'd be looking at buying the 60s. So you would buy the 60s here, a regular butterfly, right? That would be buying those 60s. Broken wing, you'd break it and go another 15 higher. So, you know, you break the wing by selling that call spread and buying these 75s. It's still giving you a debit here, but that would be considered something along the lines of those broken wing butterflies. That doesn't fit my rule for the broken wing butterfly, because if I'm adding risk to the upside, I should at least get a credit for it. Well, with this strategy, let's go back and do this again and do the 45s, right? Selling 2 of those. If you wanted to make this IRA appropriate or get the rules where it's a defined risk strategy, you can go out here in time or way out on the curve and buy one of these options. I usually say, you know, whatever option you can buy for a nickel, that's the one to buy, but this is a little bit ridiculous. I'd probably go in here and say, you know, something right around these 2 or 3 deltas, 50 cents wouldn't really hurt me too much. So that would be the one that I would go out there and buy, still be able to build this strategy out as, and you can see it saying butterfly. It is a broken butterfly in a sense, but I'm still collecting a credit. Now, I'm never going to let this underlying trade all the way up to 335 and say, hey, you know, I've got my defined risk strategy. I've got nothing to worry about. No, that just makes it, you know, all right, well, we got past the negotiate or the rule makers that really don't understand risk. Like, you know, yeah, you limited your risk, but did you really? Not really. Okay, so I would never suggest, you know, resting on this and saying, I've got defined risk, I'm not got anything to worry about. No, I would go back to this whole idea of, you know, for me, if it breaks above the Fibonacci's on the way up, then I am going to pull the ripcord. And this just so happens to be right around where I said I'd pull the ripcord anyway. So that is right where around where my break even is, right? Maybe a little bit higher, but very close to that. So, you know, the idea here would be, yeah, well, we might stick around right here, travel up to this 245. That would be perfect. Stays right here. I still get to keep that credit, that $1.97. That would be fine by me. I'm not going to shake a stick at that. So my idea is it's going to stay right within these 2 Fibonacci's, but I am worried about a breakdown further. I'm not worried about going up, back up here into the heyday of Alibaba. You know, I'm just laying out a scenario to talk a position here, okay? And break above that, I'm out. I'm pulling a ripcord on it, right? So very similar to this is something we need to know. when we're going through this know your exit strategy before entering in the trade, that means on getting in for or out for a winner and a loser. And I always emphasize, you guys, please start writing this stuff down, where you're going to get in and out, because it'll help you stay more mechanical, all right? If you don't write it down, you'll have a tendency to bend the rules a little bit. And in order to stay mechanical, following these guidelines, especially early on in trading, is paramount to it. So we talked about this. This is the front, we're going to say the front ratio call spread. Front ratio call spread. So that's where we're taking it, right? And we know our strikes. We want to basically build this out from the at the monies, and we need a credit. Need a credit. All right, so we're buying one of the 230 calls, right? I think in the February 230 calls, and we're selling two of the 245 calls in February. All right, so that we know what we're doing. That's how we're setting it up, because I have high implied volatility. For a winner, I want to get out for 50% of max profit. All right, it takes a long time for these strategies to really work out. This one will work out a little bit faster than, say, for instance, a broken wing butterfly. So that's a bonus to this. It works out a little bit faster if you're right. But one of the drawbacks of this versus the butterfly is there is more risk to the upside. If you're newer to options trading and or this strategy, I have no problem saying 30% of max profit. But write this stuff down getting into it. Hey, this is what I'm willing to risk. This is what I'm willing to make on this, and then stay mechanical with that. You write it down. You are holding yourself accountable. If it's in your head, you don't always do that. And on a loss, I said if it breaks, let's just say if it breaks that 38 Fibonacci, I'm out for a loss. All right. So write those things down. Please do that. Also, if you don't come away with anything else other than volatility, knowing how that affects your pricing and that those being expensive or cheap, I hope you guys understand this, where please write down anytime. I don't care if you're doing a futures trade. Write it down when you're getting in and where you're getting out for a loss, because you'll stay more mechanical. Can I do that trade in the Analyze tab? Did I already do that for you, or were you, is that a newer question? Because I think a couple of them scrolled off. All right, pre-approved. I got that. Gotcha. Good idea. In some way to do the out of money, it covers the unlimited risk. Right. It covers the unlimited risk aspect for it, but please don't rest on your laurels as that being, hey, I've got a limited risk strategy in there, I'm good to go. Okay. For anybody out there that's listening, can I do the Analyze tab? Okay, I'll do the Analyze tab. For administrative purpose, not as a lazy stop loss. I'm not sure I understand your question there, Mark. Could you say that another way? Yeah, I'm going to the Analyze tab. Let's go to the Analyze tab here. All right. First off, let's make sure we got the trade in here. So I'm going to do the Analyze tab on the 230s for right now. It's a 50 delta. So I'm buying one of those. All right. For every, so I've got $13 here. I've got to figure, I've got to sell two options. How can I collect at least $13 by selling two options? Well, that's going to be these 245s. If I sell those twice at $7, then that means it's $14 collection on those two sells, right? I'm not losing anybody there, am I? So we bought one of those. We're going to sell two of the out of the monies because I bought these for 13. Want to sell those for at least enough to collect a credit. Now let's go over and analyze the trade. And you will see that I've got an old something in there. Let's get that out of there. All right, so now we can see that when I initiate this strategy, we're trading right here. That's where we currently are. Now, if it continues to this side, I get to keep this credit of $1.42. All right. If it goes up and hits the short strike, the 245 strike, that is my max profit, you guys, because that means the short calls expire worthless. It's actually called the 2x1, but yes. The short calls will expire worthless, and these long calls gain the most value, right? It's $15 in value on this long call to the upside. So that is my max profit, the width of the spread plus the credit received. So that puts me just slightly above these short calls. Now, the break even, we add all that together, and that throws us up to 261.42 is where it really should land, if I could get it right, because, you know, that short, this long call makes money all the way to 245, right? Well, that long call is at max value. That means that 1x1, the 230 long call to the 245 short call, 1. Now, as soon as you go above that 245 strike, that extra short call starts losing you money, all right? That long call spread is at max value, but as we go higher, that short call starts eating away at that max profit. So that's why you get that $15 to the upside. That's when it's paid off, all right? Trevor, you would not be able to do this in a, it's illegal in an IRA unless you go out there and buy then this strike out here that I was talking about for like 40 cents or something like that. So go out and buy this one to define that risk. On the Analyze tab, you'll see it's going to look very much like the butterfly. Let me just get rid of both of these. I don't know why it's, what happened there. I want to analyze this trade. All right, so you can see it's still feeling like unlimited risk to the upside, but if I pull it way out, you'll see that it does have defined risk to the upside. That would be IRA appropriate, believe it or not. At least I'm pretty sure it is. The margin might be encompassing of that, but because it's defined risk, it should be good. It's a way to get around the red tape, yes. All right, does anybody else have any other questions? Cool. If you guys think of something later on, please reach out to me. I have a no inbox policy. I want to make sure everybody is clear of concept. All right. So today we're offering you guys the Wolfman's Trading Bundle. Here is the link. I'll throw one over in the chat window. But hey, you know what? Hold on a second. Bear with me. I'm not gonna do that to you. I'm gonna throw the link over there in the window, but I'm giving you the link to this where we're gonna discount you guys to $497. All right, you guys. When we're talking $497, that is like a $5 option premium. So if I can save you from losing a $5 option premium, this is well worth it, you guys. You know, if you aren't following my guidelines here on this bundle, which is the most popular course, there's 4 of the most popular courses that we bundled together here. It'll bring you from a beginning options trader to basically a guru in these 4 courses, you know, over probably 60, 70 hours of content, all right? So you break that down and into dollars, it is very cheap per hour, probably cheaper than what you're watching on Netflix at that point in time on the hours of content, maybe. But this is going to be more educational, I can assure you of that. All right, so we're going to help you find out the spotting opportunities and exploit those easily, quickly. Spot opportunities. We've streamlined that process to find the right option strategy for you and basically know what professional options traders are looking for before they enter that trade. Some of that is that volatility that I gave away from you, and how volatility works. I really drilled down on that in all of these options courses, which you're getting as a bundle in that link that I threw over there in the chat window. It's a hot link that will get you there. If you're watching this on tape delay, you're going to have to punch it into your URL to take advantage of this. All right. So that's it. All 4 of those courses. There's more than just these 5 classes. We're just talking about bullet points of what's inside of all of this. There are many, many options webinars in each of those. That's just to give you a little bit of taste of what's going on. So for $497, huge discount on all of those, less than $100 each on each course for the most part there. All right. Last thing, I want to thank you guys all. Again, here is the link for the course there. Take advantage of that. Later webinars will drill down on different option components, when and where I find them. If you have any questions, comments, or ideas for future webinars, please reach out to us at 310-598-6677 or trading at protraderstrategies.com. And finally, yes, we do have a disclaimer. Please take a moment to go over this. There are risks involved in trading of any kind. We've already talked about the risks in this one. You can lose money no matter what in trading. There's no question about it. But we can try to turn those tables in our favor on turning the probability so that we aren't as much at risk there. And that's what I'm trying to do for you folks. Make sure that you guys are getting involved in a situation where you are setting yourself up for success. One of the few things we can do is do that when we are setting up the strategy, okay? And a lot of that has to do with the premiums and all of those things, right? All right. So I see a couple of questions. I'll try and get to those. I'm going to leave this here. But at the end of the day, that's all I got for you guys. Other than if you have your cameras up, you can't take that. Take it easy. All right. Let's answer a couple of these questions. I think they were coming across real quick. Trevor's got it. All right, IRA. A 1x2. Now, Trevor, if you're asking to analyze the IRA 1x2, being that is the back ratio spread, I don't do that trade. And I don't have enough time to explain all of the reasons why, but basically you're buying 2 options and selling one. So why not just go out and buy the one put or the one call for the bullish assumption? I don't understand why you need to buy 2, sell one, pay off one long one, and it just, yeah, you can increase your profit a little bit, but at the end of the day, it's not really that much. I'd rather have all that upside to the upside. Trevor says, great show. Thank you very much. If you are long an option at the money and after the stock goes your way, that option becomes in the money. Do you roll that option up or not? Do you just roll that delta? No, I don't roll anything with this, George. If the underlying really fell out of bed and was heading down and now my assumption changed, okay, it's not coming back up here, I might roll one of those short calls down just a little bit for fun and collect a little bit more credit. But most of the time with this one, I'm going to kind of like leave it be. I never like to make adjustments to a strategy using the option that I bought. Okay. I don't really like to do that because it seems like you're chasing premium that way. So it doesn't really make sense there. That makes sense, George. All right, thank you for the webinar. A lot of information. Appreciate it, Alexander. Thank you very much for the kind words. Great answers. Appreciate it, George. Thank you very much. All right, that's all I got for you guys. Please take advantage of that so you guys can get on that course. It's going to be one of the last times we're offering that. So if you can take advantage of it, use some of that Christmas money. All right. It'll save you next year's Christmas money. I look forward to the recording since I was interrupted the entire time. Chris, appreciate it. Yes, please take a moment to go over that and comment on it. Guys, please comment it. Share it with one of your friends. That's the best form of flattery in this type of environment is if you share this with a friend to help them out, maybe your mentor or something like that, or your trading partner, get them on board. All right. So take care, you guys. Bye for now.